Guys, your emergency fund, if you have one, is probably in the wrong place. And no, I'm not talking about investing it in stocks. I'm talking about the mistake of letting your emergency cash sit in a local bank down the street, earning you almost no interest. Hear me out on this. This is why I don't keep my emergency fund at a bank. There's a smarter place for your emergency money, and most people are overlooking this. And before you click away, I already know what you're thinking. You've got a high yield savings account somewhere, and you did everything you were supposed to do by putting your money there. But stay with me for a few minutes, because what worked in a rising interest rate environment does not work the same way when rates are coming down. For the last couple of years, high yield savings accounts looked amazing, right? Why? Because the Federal Reserve was aggressively raising interest rates. As the Fed funds rate went up, banks raised the rate that they were paying you in those high yield savings accounts. Everybody felt smart. Everybody felt all disciplined, right? I get it. But here's the part most people miss, okay? High yield savings account rates are variable. They go up fast and they come back down just as fast. And as the Fed begins cutting rates, which we know we've already seen, the yields on those high yield savings accounts will go down as well, quietly, automatically, and sometimes without you even seeing the warning. Oftentimes they will let you know, but are you checking that email daily? Is it going to your spam? Who knows? So the real question is not, is a high yield savings account bad? The real question is, what happens to your emergency fund when yields fall, but inflation and the cost of everything around you is still steady increasing? That's the conversation that we need to be having, okay? This is where most people are surprised. My emergency fund does not sit in a traditional savings account. It sits inside of a brokerage settlement structure tied to money market funds, not necessarily stocks, not speculative investments. And I'm going to explain exactly what that means and why it matters. I'll also walk you through how this can be done at Vanguard, Fidelity, and Schwab later in the video. So stay with me for that. But first, we need to fix how people think about their emergency fund. An emergency fund is not a checking account. It's insurance. It's not money that you swipe every week. It's not money for convenience. It's money you want available for you and stable and intentionally boring so that you're not touching it. And here's the reality. Most people in their 30s, 40s, and 50s, they don't touch their emergency fund for years oftentimes, which means the real risk is not daily access, but the real risk is yield decay over time, inflation, erosion, right? And leaving meaningful money in the wrong container. That's where traditional savings accounts quietly fail people who are otherwise doing everything right. So here's the mental shift that changes all of this, okay? A brokerage account is just a container, just like a bank, right? A bank is a place where you store your money. And a brokerage account, we always think of it as a container where you store your investments. But you can also use that brokerage account sort of like a bank, because inside a brokerage account, you can hold something called money market funds. And these are designed to be highly liquid, relatively stable, and typically they pay more than a traditional savings account at that bank down the streets, especially over full rate cycles where interest rates go up and then interest rates come down. That's a cycle, right? This is why institutions, corporations, and a lot of sophisticated investors, they don't park idle cash in checking and savings accounts. They use money market accounts. Now, let me be clear, because this matters. Money market funds are not FDIC insured. That doesn't mean they're unsafe. It just means they're structured a little differently. Brokerage accounts are protected by SIPC, which protects you if the brokerage itself fails or goes out of business, right? Now, it doesn't protect you against market loss. And government money market funds, the ones that I'm talking about, hold short-term U.S. Treasury securities and government-backed repurchase agreements. In other words, when we're talking money market accounts inside of a settlement account at a brokerage firm, you're not lending money to a random company. You're holding government-backed instruments designed specifically for capital preservation and liquidity. So this is not about chasing a high yield. That's not what I'm saying. This is about placing cash intelligently in the right container. And to be clear, this is an idea for you to consider. It's not a mandate. It's not something that you got to go out and do. It's just something that you need to be thinking about if you have an emergency fund that's sitting down at some local bank, not getting you very much interest at all, right? Everyone's situation is different. Okay, now let's talk Vanguard specifically. At Vanguard, your settlement fund is already a money market fund. Your settlement fund, by the way, is the place where your money sits in Vanguard before you move it on to an investment somewhere. It has to be sitting somewhere before you can invest in whatever ETFs or index funds or whatever you want to invest in. That means your cash in this settlement account is liquid. It's earning a competitive yield, a competitive interest rate, and it doesn't require constant management from you. It just sits there in the settlement account and earns interest. Not a bad place for an emergency fund. This is a true set it and forget it emergency fund structure if you want to do it. Now, one important caveat here. Vanguard is not designed for daily spending, okay? There's no debit card that's tied to this settlement account. And honestly, that's a feature, not necessarily a problem. Emergency money shouldn't be convenient to spend. So if you decide to say, I want to keep my emergency fund in the Vanguard settlement account, if you need money from that account, it will take a couple of days for you to get it. At Vanguard, the key thing you want to understand is the Vanguard Federal Money Market Fund, ticker symbol VMFXX. Now, VMFXX acts as the settlement fund or core cash position for most Vanguard brokerage and retirement accounts. What that simply means in plain language is this: any new deposits into Vanguard, any uninvested cash at Vanguard, any proceeds from you selling investments at Vanguard, they're all automatically swept into VMFXX, right? That cash, while it's sitting there in the settlement account, earns interest, remains liquid for you to use, and stays available also for trades and withdrawals in terms of your investments. There's no extra setup required to buy it. It's built into the system over at Vanguard. This is why a lot of people use Vanguard as a set it and forget it structure for emergency or even idle cash, because any money that you send over to Vanguard, it's going to be sitting right here in this settlement account, getting good interest anyway, until you make a decision where you want to move it. But I'm telling you, you can leave it right there. Now, remember, there's no debit card associated with it. There's no daily spending features. And again, that's intentional. Your emergency fund shouldn't be so easy to get to that it's tempting for you to use it. Now, let's talk about Fidelity real quick. Over at Fidelity, it gives you one of the most flexible setups that are available. With their cash management account, your core position can be a money market fund like SPAXX. So we're clear. SPAXX over here at Fidelity is a money market mutual fund that serves as Fidelity's default core position or cash holder for your Fidelity brokerage account. So just like Vanguard has what they call a settlement account, Fidelity has what they call SPAXX or SPAXX. And just like over at Vanguard, it's a holding container for uninvested cash, automatically earning interest while keeping the funds liquid, highly liquid for trading or for withdrawal for you. So you could use this over at Fidelity as your emergency fund. That means over at Fidelity, you get a strong emergency fund type structure. Plus, watch this, with Fidelity, you get some light banking features with this SPAXX account, SPAXX, if you want them, right? Now, over at Fidelity, this appeals to people who want fewer accounts and a more consolidated system. For many disciplined adults, guys, Fidelity strikes a strong balance. That particular fund typically acts as the default sweep vehicle for uninvested cash over at Fidelity. So in practice, that means cash is automatically swept into SPAXX over at Fidelity. It stays liquid, it earns interest for you, like I said, and it can be accessed or deployed with very little work from you. Fidelity also layers on, this is the beauty about Fidelity, they put some optional banking features on it too, which some people consider to be very valuable. This is why Fidelity often appeals to disciplined people who want a clean cash flow with their emergency fund in case they need it, right? But again, the key isn't the brand, whether it's Fidelity or Vanguard or whatever. The key is understanding that just like over at Vanguard, here over at Fidelity, your uninvested cash is actually sitting in something that's gaining a nice piece of interest, more than the bank down the street. Now, let me explain a little bit about where even people that are financially responsible tend to sort of get tripped up on. Okay, first, mixing emergency fund with spending money. You don't want to do that, right? That's how emergencies quietly turn into lifestyle purchases. So you got to be careful there. Secondly, chasing higher and higher interest rates. Not always the thing that you need to do with an emergency fund, because we got to remember, emergency money really has one priority, guys: availability, right? And then interest is sort of a cherry on the top, right? But the money has to be available for you when you need it. Because if you miss that order and you're putting the interest above liquidity, then you defeat the whole purpose of even having an emergency fund in the first place. The reason you call it an emergency fund is so you can get to it in emergencies. Guys, real quick, if this is clicking for you and helping you, this is why I say that most people don't really necessarily need more money. They need a better system. Inside my 4-step financial reset, we're going to be talking through decisions like this, step by step: your emergency funds, where to put your money, the investing order that you want to go through. All of that stuff is going to be inside this 30-day 4-step financial reset. If your money feels right, but it's not optimized, click on the link below in the description box to get in the 4 steps financial reset that is coming up soon. Enrollment is open. Now, let's get back to the video. Now, guys, let's talk Schwab. Schwab works a little differently than Vanguard and Fidelity. By default, Schwab sweeps all of your available cash in their brokerage account into a low interest bank account. Very similar to your local bank account, right? Where you get a little tiny return on your money. So over at Schwab, if you want to earn competitive interest on your money, you need to manually purchase a money market fund. So Schwab is a usable place to keep your emergency money, but it's just more hands-on. That's why I mentioned Schwab as being sort of different than Vanguard and Fidelity if you want to keep your emergency fund there. Schwab works differently, and this is where many people get confused. Schwab doesn't offer a direct, automatic, high-yield money market fund sweep to keep and contain all of your cash, right? So over at Schwab, any uninvested cash is automatically held in a cash features bank sweep account, and that account typically pays a very low interest rate. Now, Schwab does offer, as I said, money market fund alternatives. And this is important, guys. Like I said, you have to manually purchase those funds. So Schwab can be useful, right, for this strategy. It just requires a little more intentional management on your part. My preference is Vanguard. And if you want some of those extra banking features, Fidelity. But that's why I describe Schwab as being usable, but not as good as the other two. Now, let me say this very clearly, guys. I'm not telling you what you must do. I'm not giving you individualized advice here, but I'm absolutely telling you to make sure you review each of those 3 platforms' disclosures. Make sure you understand how the sweep of all of your available cash at whatever brokerage you choose, how it works. What are the verified yields? What is the access? What is the protections that you have? And you decide what fits your own risk tolerance and behavior. Again, if you want to keep your emergency fund in the bank down the street getting 0.000% interest, that's fine. But I'm just telling you, there's other alternatives. And with these other alternatives at these brokerage accounts, these structures change all the time, right? So you got to be paying attention and learning. The point of this video is not to hand you an answer, right? In fact, that's not the point of any video I do. The point of any video I do is to introduce you to an idea that you should consider, especially when we're in this type of climate that we're in right now, where rates are going down and high yield savings accounts won't be as attractive as they've been in the past. Now, I need to be honest with you guys, because this is where people need context. Any money you hold in one of these brokerage settlement accounts and money markets funds is not the same as cash sitting in your local bank down the street. In most cases, you're not walking into a branch and pulling out cash, right? You're not getting money instantly when you need the money at the ATM, right? You got to understand that. Depending on the platform and how your account is set up, it may take a day or two or over a whole weekend to move that money back from your brokerage account into your bank so that you'll have the actual cash. That's not necessarily a flaw. That's just a design trade-off that you need to make sure that you understand. Emergency money is meant for what? Job loss, medical bills, home repairs, automobile repairs, unplanned expenses. It's not meant for daily cash needs. It's not meant for same-day discretionary spending because you ran out of money and you got to go buy that ticket or get that concert ticket, or you got to go buy that outfit, right? Or any of the I forgot my wallet type moments, so let me go ahead and dig into my emergency money, right? So I'm not saying eliminate banks entirely. I'm just saying consider these brokerage accounts, these settlement accounts for a bulk of your emergency money. Here's the rule of thumb, right? Your emergency money should live somewhere that is easy to access when needed, and it's not tempting you to spend, and it's not quietly losing ground over time. Now, that's why for me, a settlement-based money market structure makes more sense than a traditional savings account. Just remember, guys, this is not a one-size-fits-all thing. This is really for disciplined people who already have savings and want a cleaner system. This is not for people who need instant access to emergency money as spending money. If that's you, then maybe you should keep some money down at the local bank. But you got to know yourself, and you got to design your system accordingly. And again, if you want to help putting this entire system together for you, that's what my 4-step financial reset is all about. Don't forget that link in the description box below. Bottom line is this: banks are not evil. Savings accounts are not just useless. I'm not saying that. But in a changing rate environment where wherever your money is sitting matters, smart money adapts. And this is a way for you to adapt. Listen, if you got value from this video, do me a favor, smash that like button and share this video with somebody who you think needs to hear it. Guys, the best person who's going to take care of that old you is the young you. Until the next video, peace.